The United States Federal Reserve, commonly known as the Fed, has made decisions that could alter the course of the global economy, reducing interest rates. If you've ever wondered why prices rise, why mortgage rates skyrocket, or what factors influence an economy's growth or recession, much of the answer is tied to the Fed's policies. And just a couple of weeks ago, this powerful institution began to make significant adjustments in its approach, something that affects not only the United States but the entire world. Recent moves indicate that we may be entering a new phase. After a period marked by constant increases in interest rates, the Fed has begun to make adjustments that some consider a change of course. While some economists are celebrating these cuts as necessary relief to avoid a recession, others warn that the fight against inflation is not over. What do these cuts mean for the global economy? Are businesses and consumers about to see a reprieve from high costs? And what can we expect in the near future? In this video, we'll discuss everything you need to know about these recent changes. We'll explain why the Federal Reserve raised rates so much in the first place, what factors led it to reconsider its stance, and how its decisions can affect your life, your investments, and your finances. Why are interest rates so high? To understand recent changes, we must first analyze the context that brought us here. In 2020, the U.S. government was forced to spend huge amounts of money to support people who were unable to work due to quarantine restrictions. With businesses closing massively and many citizens unable to go out to work, tens of millions of Americans received money from the government as part of the stimulus plan. These payments were essential for the population to cover basic needs, such as food, hygiene products, and other essential goods, while they were confined to their homes. However, although people were still receiving money, the main problem was that many factories and businesses were also closed or working at a greatly reduced capacity due to the same restrictions. This led to a sharp drop in the production of goods and services. In other words, there were fewer products available on the market. This combination of factors created an imbalance in the economy. On the one hand, people had money in their pockets and wanted to spend it, but on the other hand, businesses could not produce enough goods to meet that demand. Just as the economics books say, when many people try to buy products that are not available, the prices of these products tend to rise. As a result, prices for many goods, from food to household appliances, began to rise rapidly, affecting the country's overall economy. This image shows how the inflation rate in the U.S. went from 0.6% in June 2020 to more than 9% in July 2022. Thus, inflation, that is, the general increase in prices, became a serious problem for Americans, as they increasingly needed more money to buy the same amount of goods as before. To combat this phenomenon, the Federal Reserve has a key tool: raising interest rates. The answer to this question now is, how can an increase in interest rates reduce inflation? The process is simple to understand. When a central bank raises its interest rates, it is essentially making it more expensive to borrow money. That is, if someone wants to take out a loan, they will now have to pay more interest than before. This affects entrepreneurs in particular, who will no longer find it as profitable to take out loans to open new factories or businesses. By not making these investments, new jobs are not created, and as a result, unemployment increases. People without jobs do not have money to spend on products or services, which reduces demand and the level of sales. When people stop buying as much, prices simply start to fall. Therefore, in March 2022, the Federal Reserve raised interest rates to curb inflation. And since then, the Federal Reserve has continued to raise interest rates, keeping them at around 5.5% until September 2024. And with that measure, we can see how the inflation rate gradually decreased until reaching 2.5% in August 2024. We see in this way how the high interest rate policy carried out by the Fed was a success and ended inflation in the United States. The recent Fed cuts. As we said before, after a couple of years, the Federal Reserve has decided to lower interest rates aggressively after controlling inflation. This decision has a huge impact on many things, from how company stocks perform on the stock market to house prices. Understanding what is happening is essential to anticipate how this may impact your financial situation. If you found today's video useful, don't forget to give it a like and subscribe to the channel to stay up to date with our upcoming content. Let's move on. Let's continue to analyze the real estate market, which is about buying and selling properties such as houses, land and buildings. When interest rates fall, obtaining mortgages becomes more affordable for buyers, which can stimulate demand for housing. This means that more people will be able to finance the purchase of a home, which can lead to an increase in property sales. But that's not all. House prices may also start to rise, as increased demand can push up property values due to the law of supply and demand, as we saw earlier. In this chart, the blue curve shows the Federal Reserve interest rate, and the red curve shows the average home price. We can see that when the interest rate is lowered, home prices increase. For those who have been considering selling their properties, this change may prove to be a favorable opportunity, as they could obtain better prices for their homes. However, it is not all positive. While lower rates may make it easier to buy houses, they may also raise some concerns about a possible housing bubble if prices rise too quickly. Let us now move on to the financial market. When the Federal Reserve decides to lower interest rates, the financial market usually reacts upwards. Here the blue line represents the interest rate set by the Federal Reserve, while the orange line is the value of the S&P 500 stock index. In simple terms, when the Fed raises rates, the stock market falls. On the contrary, when rates are low, people invest more in stocks, so the stock market rises. To understand it better, let's break it down. First, one of the main reasons is that low interest rates reduce the cost of borrowing. When the Fed lowers rates, both consumers and businesses can access financing at a lower cost. For businesses, borrowing for projects, expansion, or improvements is much cheaper, which increases their profit margins. With more money available to grow, their stocks tend to rise in value as investors anticipate better future performance. On the other hand, when interest rates fall, fixed-income financial instruments such as government bonds become less attractive. This happens because the yields on these products are directly linked to interest rates. If the rate falls, the interest that investors can earn by buying bonds also decreases, causing investors to look for other more profitable alternatives, such as stocks. This movement towards stocks drives up prices in the stock market as demand for these assets increases. Another point to consider is that low interest rates often lead to a climate of greater economic confidence. When consumers and businesses have access to cheap credit, spending and investment in the economy increases. This increase in economic activity reinforces confidence in the future, and, as a result, investors feel that it is a good time to place their money in the stock market. This knock-on effect generates a rise in stock prices. Rate cuts are often interpreted as a sign that the Fed is willing to support the economy, which gives investors peace of mind. This support can lead to an increase in stock purchases, as it is believed that the Fed will take action to prevent a recession or any significant economic slowdown. Finally, when the Fed lowers rates, the dollar generally depreciates against other currencies. This benefits American exporting companies, as their products become more competitive in the international market. The revenues of these companies increase, and their stocks usually rise as a result. And finally, we have the labor market, one of the most important variables in the economy. The labor market is not immune to the decisions made by the Federal Reserve, since its policies directly influence job creation, wages, and job stability. The first effect comes from the side of companies, since when the Fed lowers interest rates, the cost of borrowing is reduced. With access to cheap credit, companies can afford to invest in the growth of their businesses, which usually translates into the need to hire more workers. For example, if a company takes out a loan to open a new production plant, it will need additional employees to operate those facilities. This increase in business investment creates new jobs and reduces unemployment. Lower interest rates also directly benefit consumers, as they get more affordable loans to make large purchases, such as homes or cars, or to spend more on products and services. With more money available to spend, consumption increases, and this benefits businesses that sell products and services. When companies see an increase in demand for their products, they often need more workers to meet it. This creates a domino effect in the labor market, as companies must hire more employees to handle the increase in production, customer service, distribution, and other tasks. We see how in this way, consumption growth, driven by low rates, directly contributes to job creation. Additionally, low interest rates also help businesses keep their workers in times of economic uncertainty. When interest rates are high, many businesses are forced to cut costs, which often means cutting staff. However, When rates are low, businesses can refinance their debts or access cheaper loans to keep their operations afloat without needing to make mass layoffs. This provides greater job stability, which not only benefits workers but also helps the economy as a whole, as a more stable labor market fosters consumer and business confidence. Let's now look at some historic moments of interest rate drops. Something we should keep in mind is that this decision to sharply lower interest rates by the Federal Reserve is not the first time it has happened. A clear example of this was the financial crisis of 2008, when the Fed implemented a similar policy to deal with a critical economic situation. At that time, the U.S. economy was collapsing after the real estate bubble burst, which led to a global recession. To stop the fall and try to revive growth, the Fed made the drastic decision to reduce interest rates to practically zero. What happened after that decision? In the short term, the rate cut had a positive impact on certain sectors. Lower rates made it easier for companies to borrow at a lower cost, allowing them to invest in new projects. Many of them took the opportunity to expand their businesses, which helped boost job creation at a time when unemployment was at alarming levels and would reach 10% in 2009. On the other hand, consumers also benefited from these low rates. People began to have more access to credit for the purchase of houses, cars, and other goods, which helped to revive consumption. The real estate market, which had been the epicenter of the crisis, began a slow but steady recovery thanks to low-interest mortgages, which allowed many families to access housing. The stock market also experienced a rally as low interest rates made equity investments more attractive compared to the relatively low returns on other financial instruments such as bonds. Here we can see how the S&P 500 index began a new bullish cycle starting in 2009, when the Fed was reducing interest rates. However, the effects were not only positive. In the long term, this low-interest policy encouraged massive borrowing in both the private and public sectors. Many companies and governments took advantage of the favorable conditions to borrow enormously, creating a buildup of debt that still persists today. In the last 10 years, the U.S. government debt has increased by 100% to $35 trillion. Moreover, the recovery of the real estate market was so strong that house prices rose again rapidly, reaching levels that were unattainable for a large part of the population. What can we learn from this experience for the current scenario? Could the recent Fed rate cuts trigger effects similar to those observed after the 2008 crisis? Well, in the short term, we are likely to see a revival in key sectors such as real estate and consumption, as lower rates allow for greater availability of credit. This could encourage business investment and job creation, which would help improve the overall economic situation. However, we must be cautious about the potential long-term risks. If rates remain low for too long, this could lead to excessive borrowing and the formation of speculative bubbles in sectors such as real estate or the financial market, as has happened in previous years. So while rate cuts may be a short-term relief, it is also crucial to consider the effects they may have in the future. We've seen how Fed decisions can change the course of the economy in a matter of months, affecting everything from the labor market to housing and stock prices. Right now, the Fed has begun to signal a change of course, cutting interest rates from 5.25% to 4.75%. And this is just the beginning, as it has planned 2 more cuts of 0.25% by the end of the year. History has taught us that the effects of these decisions are not felt immediately. The economy may appear calm for a while, but beneath the surface, risks may be building up. Now the big question is the American economy at the beginning of a new stage of economic prosperity, or is it heading towards a more uncertain and dangerous scenario? How do you think these changes will affect your financial decisions from now on? Let us know your thoughts in the comments. I'll see you in the next video.